Yo no. Pero...
¿Se registraron aquí? Hace un momentico con... ¿Cómo estás? ¿Le conviene unas fruticas? Tenemos sándwiches. ¿Qué quiere pasar?
Can you allow me in? All right. The iPad that you left in there has 5% battery.
It dropped a lot. Yeah, we got like 30. Just
I have no clue. I don't know if there's a way to plug it or...
yeah. Is there a charger?
No idea. There should be.
Sorry.
I have no clue. But I just saw it and
Okay, we'll get a charger. Yeah.
ready to go, right?
Yeah. We just are gonna unmute you.
Hmm?
I'm gonna unmute you.
Okay. People are sitting down. Stand.
Queremos.
¿Qué te iba a decir? Yo firmé el papel hoy y ya te lo mandé. Ese dinero, ¿a dónde se va a invertir? Porque mi hermana dijo que
Se
no.
va a ir al money market.
Pero mi hermana me dijo algo de internacional.
No. Lo de ella es diferente de lo suyo.
¿Y por qué no soy igual a mi hermana?
Porque ustedes son diferentes.
Me pidan una cita y vamos. No, porque ¿para qué le quito el tiempo? ¿Qué tal? ¿Cómo estás? Gracias.
Miguel.
Hola. Bye. See ya, Yaman. Have a good night. See you. See you. What are you bringing?
I have an iPhone charger with a box.
Bobby one. No. You want it in red or white? No, whatever you want. Whatever you want.
Hi, how are you?
Good, how are you? Hello.
Tenemos sándwiches y frutas,
Buenas noches. Fírmame aquí, por favor. Whatever you want, Ash. Okay, Mom. ¿Qué tal todo? Me encanta esa falda. Está muy super chuch. Gracias. ¿Es clienta o? ¿Cómo? ¿Usted es clienta? Sí, claro.
Okay. I guess we're gonna start. Yes. We have some people coming in. We have people coming in and we will start. How you doing? How are you? How you guys doing? Everybody's doing good?
Yes.
Yeah? Not rain today? No? Thank God. All right. So everyone's welcome tonight. We are live streaming tonight, so we got people linked up. My name is Miguel Castañeda. For those of you that know me, for those of you that are clients, have worked with me. If you haven't worked with me, I work here. I've been here for 15 years. It's a long time. Yeah, I know. I didn't have facial hair when I started working. Now I do. So it's been a while. We do these events every month, and we do 2 of them a month. We do one in Spanish, one in English. We did this 2 weeks ago in Spanish, so today is going to be for the English public. Welcome everybody that's online, that linked up today. We're going to be talking about something that's interesting, inflation and interest rates. And we decided to talk about interest rates and inflation today because we recently had a meeting on the Federal Reserve Board to decide whether they were increasing or not interest rates. And we also recently had the CPI, the Consumer Price Index, for the month of October come in right now, okay? So we want to know how inflation is affecting the markets, and we want to know how interest rates will continue to affect or dictate the pace of the markets, okay? Julie is going to connect this iPad so that we don't run out of battery here. So I wanted to talk about inflation and interest rates, but I wanted to give you a little briefing of the stock market. Have you seen how the market has been performing over the last 2 weeks? Has anybody seen how the stock market has been performing over the last 2 weeks? No? Nobody? Take a guess. Has it been up or down?
Up. I think so.
How many people say up? How many people say down?
Say it's up and down.
It's been swinging up and down? Okay. So the market was on a negative run for about 3 months. Since its peak by the end of July, the market went on a downturn all September and all October. August, September, and October came out negative. Okay? So up to July, the market had grown about 19% from the beginning of the year, all the way until the end of July. So it was an amazing year up to then. And then we saw red for 3 straight months. So people were panicking, thinking, here we go again, looking at a 2022 again, and the market going down and then erasing all those gains that we saw at the beginning of the year, right? But then the market decided to bounce back. And it bounced back due to what happened with interest rates and inflation. Okay? So we're going to talk about that today. And we're going to talk about some other stuff in regards of the market. When we look at inflation, does anybody know how do we measure inflation? Or first of all, what is inflation? Does anybody know what is inflation? Inflation is the increase in the cost of goods or the cost of living, which happens every year, right? Every year, coffee goes up, bread goes up, eggs, milk, everything goes up in price. That is inflation. Now, inflation is part of the system, has always been of the economical system, and will always continue to be there because inflation needs to be there for growth to happen. Okay? Every company, every product, every service that is sold will not remain to be the same price forever. And I think we all understand that, right? It will go in price because production cost goes up, oil goes up, okay? Manufacturing goes up, and therefore all the products and services will eventually continue to go up. Now, what we don't want is inflation going up drastically. What we want is inflation going up at a good rate, okay? Now, how does the government measure inflation? Well, they measure inflation based on something called the Consumer Price Index. The Consumer Price Index, or CPI, is the measurement or is the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. Okay? The government goes every month and does research about these components. The last slide had the breakdown of 2022. I researched that 2022 so that we could compare how that has changed from December of last year to this year. Okay? And as you guys can see, the breakdown is as follows. You got about 44.4% that is taken into account and is housing. Anything that has to do with mortgages or rentals. So 44% of that index, of that measurement, has to do with housing. Okay? How many of you know if housing has gone up over the last year, 2 years? Drastically, right? So that means that 40% accounts for a lot, and that a lot has gone up drastically over the last 2 years. Then we have food and beverages, which is about 15%, 14.4%. And we got transportation, which is about 16%. And then we have the breakdown of medical care, recreation. A lot of people think that apparel and recreation is a huge part of the consumer price index when it is not. Recreation is only about 5% and apparel is about 2.4%. The three big sectors or the three big areas that the government looks at is housing, transportation, and food and beverages. Okay, so those are the three big factors that determine how inflation is measured. Now, how has that changed from last year to this year? If we look at this year consumer price index, housing hasn't changed a lot. It's still 44%. Transportation increased 1% from 16 to 17. Food and beverages is still at the 14.2. So it remains very steady, right? Medical care increased a little bit, education and communication follows, and then there's other goods, and recreation stays at the same, and apparel stays at the same. So basically they're measuring month to month the cost of the same goods over and over again. And by the way that they do that is they collect about 94,000 prices and 8,000 rental housing units quotes each month. So most people think that the government is making up these numbers. No, they're not. They're actually doing that research. Now, are they going to every single little corner in the US? No, they are not. Now, when I tell people about the consumer price index changing and about inflation coming down or going up, usually what people think is, whatever that you're telling me, Miguel, whatever that information that you guys are providing doesn't apply to me or doesn't apply to us. Because we live in Miami and the only thing that I see is that everything costs more every day, right? But when they do the research for this, they're not coming knocking doors in Miami only, right? They're looking at the entire country. So for these numbers that they gather, it's not just your area. So I wanted to clarify that because a lot of people don't understand why is it important to understand the CPI or why that measurement is important. And that measurement is also important because based on that measurement, the Federal Reserve will make decisions whether they increase or decrease interest rates to help the economy. Okay? Now, if we talk about inflation, there are three ways in which we can see inflation happen or actually increase drastically. The first way that inflation happens is by monetary inflation. Monetary inflation means that there's a lot of money inside the system, inside the economical system. When there's a lot of money flowing through the system, do you complain about the prices or do you keep paying whatever they ask for? So, for example, 2 years ago, or 3 years ago, better yet, 3 years ago when we were in COVID, everyone was in their house, locked up. Some people were still working, some people weren't, but most people were, actually. And people that were working, did they spend that money? No. There was no restaurants, there was no travel, there was no leisure, there was none of those transportation expenses, right? So a lot of people, what they did is they save that money. Now, don't think about Miami, think nationwide. Because that didn't only happen here. That was worldwide. Now, we increase our savings. Not only we increase our savings, but the government decided that they needed to help us somehow. So they cut a huge check for everybody. Do you guys remember that? That's money coming into the system. Not only they cut money for individuals, but they decided to loan money to businesses. If you're a business owner, maybe you took a loan at a very low interest rate. And I don't blame you, I will do the same. Okay? Because if they offer you a loan for your small business at a 3% for 30 years, nothing beats that, right? But what does that make to the system? That causes a huge influx of cash into the system that now can be spent. A lot of business owners use that money to protect their businesses and to keep their businesses afloat if they needed it, right? But if they didn't need to keep their business afloat because the business was working, what did they do with that capital? Where did that money go? That money went into remodeling the business, restructuring the business, hiring more people, getting better systems. That money was spent. If there's more money being spent and there's more money going from hand to hand, the price of goods automatically starts increasing. And people don't mind paying $5 for a gallon of milk if they have the money to pay for it. If they don't have the money to pay for it, then they don't buy it. But if they have the money to pay for it, they go buy it. And if they increase it from $5 to $5.50, they will still buy it if they have the money. So money supply, or the influx of money in the system, can cause inflation to skyrocket. Okay? Now the money supply increased, as you guys can see here, in 2020 drastically. So since 2020, we've seen that amount of money going from hand to hand and increasing the cost of goods. Okay? Now, another thing that can increase inflation, or can, trigger inflation to go up, is the consumer price inflation, right? That has to do with how we consume, the supply of goods compared to the demand of goods. And what happened, it has happened after critical events like World War I and World War II, where inflation has skyrocketed, okay? And that happens when there's delay on goods production, or there's a lot of demand of something that we don't have enough supply of. And what happened during the pandemic is that a lot of businesses shut down, or a lot of businesses delayed their productivity, right? And that's why you had cars that you were trying to buy, and they were telling you can buy the car, but it will come in 5 months. I don't know if anybody experienced that with cars, furniture, or remodeling your house and asking for things to be done, and they didn't have the materials, or they didn't have the production for that good. Now, the minute that they don't have that material or that production, if you want to get it before your neighbor, guess what's going to happen? You're going to have to pay more. And that increases the price of goods. Okay? So we are part of that problem in increasing the price of goods, because I want to get it before my neighbor, then I'm going to increase the price on that item that I want. All right? So that's another way of how this can have inflation be triggered. The other thing that can trigger inflation is the asset price inflation, okay? And the asset price inflation applies to something like stocks or real estate. And what happened to real estate over the last 3 years? It drastically increased, right? During COVID, housing was skyrocketing. House prices were doubling, tripling, right? People that purchased something in 2020 and sold it by 2021, 2022, they made a ton of money, okay? Because that one asset increases in price, and it's 44% of that consumer price index, it automatically causes inflation to go up, okay? Have we gone down in prices for the housing market? Have we gone down in prices? Stabilizing? Is it decreasing? We don't know. No. We don't want to comment. So it depends on where you're located. If you live in California, for example, prices have gone down from their peak. If you go to Seattle or San Francisco, prices are down probably 6 to 7% from its peak. In places like Miami, that hasn't happened. So our perception of the housing market has been it just keeps going up. It doesn't stop. But that's not true nationwide. Okay? And you guys can go and seek that information and you'll find out that those prices have come down in other places. So it depends on what you're looking at. But once again, the government doesn't look at one place. We all think that Miami is the only important city in the world, which is not, but we still think it, right? Because we live here. And we think that the world revolves around where we live and not everywhere else, right? But that's not true. Once again, we find out that they take into account other places. So in this case, that's the other factor that has created inflation over this last 3 years. Now, has this been the worst time for us to deal with a high inflation? Not really. If we look at the history of the U.S. over the last 100 years, inflation went all the way up to 20%, somewhere around the 1920s, about 1918, 1919. Do you guys remember what happened back in 1913, 1914? First World War, right? So after the war, inflation skyrocketed. Remember that I just mentioned some events will cause that to happen because of the demand of goods and the scarcity of goods, right? So that happened back then. Now, obviously, we weren't there, so who cares, right? It doesn't matter. Now, around here in the 1940s, it also skyrocketed. About 18%, 17% inflation. Okay, some good double digits there. Once again, World War II. Okay, now there's another section here that is around the 1970s, 1980s. You guys see these? 1970s, 1980s. Now, did anything happen before that to trigger that? OPEC? No, there was no major event that actually triggered that inflation. That was triggered by consumption and the increase of prices and the other things that we said. And that has been the only precedent that we actually have compared to what we are going through right now. So that's why when you hear the news, they always refer to the 1980s inflation and how the Federal Reserve dealt with this. And the way that the Federal Reserve dealt with this is the Federal Reserve increased interest rates from one day to another. They took interest rates all the way up to 18%, 20%. If you were buying houses around this time frame in the US, do you know how much mortgage rates were? Anybody? No? About a 16%, 18%. You were buying a car, you were paying 20% on that car loan. Now, we don't remember. Maybe we don't want to remember. Maybe we weren't here then. I don't know, right? I was just a baby back in the 80s. But this happened. And the way that they control that inflation is by increasing those interest rates. Okay? Now, around the 90s, somewhere around here in the 90s, there was, some sort of risk of inflation going up. And the Federal Reserve came up with this concept called the soft landing. And the soft landing concept is something that you probably have been hearing in the news lately. And it's something hard to achieve. Okay? It's managing those interest rates so that there's a slowing economy so that people are not purchasing enough and the prices come down. The way that they do that is by increasing interest rates so that the flux of cash slows down. The more it costs you to loan money to go purchase a new house, a new car, the less you are tempted to do it, right? If it costs you 8% to buy a house right now because the mortgage is high, then people will think twice. And they will probably not purchase that house, which is going to cost to what? That price of the house dropping. Same thing for the cars, same things for all goods. And that's what's happening right now, okay? So I wanted to give you a little bit of history or background on the inflation subject because a lot of people have asked me about it and they don't quite understand why is it important. And someone asked me once, hey, can the government just get rid of inflation? And I said, yeah, they could, which means that what is it that you do? You sell coffee? Then that means that you're going to sell coffee for the rest of your life at the same price forever. And he goes, no, I'm not going to do that. That's dumb. That's crazy. Why would I do that? I get it. I got to make more money. I told him, well, yeah, you increase the price, then there's inflation. It will not disappear. It's part of the system. Now, what we need to is control it. And that's what the government job is, right? Now, if we look at inflation from 2003 all the way until now, and this is important because 2 weeks ago when I did the other seminar, this number wasn't here. So we were speculating about that number. When we look at inflation, inflation has been pretty steady, if you notice, month to month, right?
Is that year over year?
That's year over year compared to that month in the previous year. Yes. Yes.
So when you say 3.2, it's above the 7.7.
Exactly.
That was the previous year. Okay.
Exactly. Yes. So the measurement they do is important for two things, right? They want to see that coming down from last year, but they also want to see that coming down month to month because it's important for them to understand how consumers are behaving, okay? Now, if we look at that inflation, in 2009, you see some negatives here in that line? So we had some months with deflation in 2009. Deflation is, a price of goods going down. And that happened right after the crash of 2008, which is obvious, right? Market crash, the not just the stock market, but the real estate market crash, stock market crash, everything went down in price. We suffered deflation. But if you look at this table, it's very steady. And we haven't been over 4%, 3% since 2003. So over the last 20 years, it hasn't been over 3% or 4%. Only until 2021, we started seeing an increase on that inflation. It went from 2.6 to 4.2, 5%, 5.4. It stayed in the fives for a few months, and then it jumped to the 6% and ended up the year at 7%. We started this year at a 7. I started 2022 at 7.5, and it increased all the way to 9.1 in June. Now, I don't know if you recall, but last year in June was the highest price point for oil, gas, petroleum. Do you guys remember that? The gallon of gas was pretty pricey back in June. And then it dropped, right? It dropped from 9.1 to 8.5. But once again, the Federal Reserve started increasing interest rates in March actually, last year. Okay? And they went heavy on it May, June, July. They did 3/4 of a point each time. I'm going to show you that in a second because we're going to go over that in a second. But that's what happened. And they did that in order to contain that inflation hitting the double digits because they were really afraid that if we would go into double digits, then we will experience a 1980 scenario once again. And so they wanted to avoid that. So that's why interest rates have been going up. Okay? Now, they were able to manage that to come down to 6.5 by the end of the year. And then this year, they kept increasing interest rates and lowering inflation. And we got to a 3% around June. But then it went up for a couple of months. And so they kept with the hikes. They kept increasing interest rates. And then it slowed down this past month. So the Federal Reserve decided to not increase interest rates anymore, which allows the market to run its course and get on the positive side of things. And that's when the market bounced back. And it bounced back really hard because now the expectation is that the Federal Reserve is not going to increase anymore. They still have one more meeting in December, but it looks like they're not going to increase anymore, at least for this year. And if they don't increase anymore this year, most likely next year they will pause, and then they will come onto a lowering interest rates cycle later next year, most likely. Third or fourth quarter next year. So it's not going to happen right away. Some people think that that could happen right away. It's not going to happen right away. The way that, yes.
Can we ask you questions?
Sure, yes.
No, so I understand that the market, the companies have a lot less cash to draw from capital, right? Is that what drives the market down?
No, necessarily.
So
The market has, so a lot of people always want to figure out what is it that drives the market down. And there are so many different factors that drives the stock market down. Okay?
But you made the comparison. You mentioned it. That's what I'm saying. You said that drives.
So the drive of the interest rates going up doesn't have to do directly with the interest rates, but with the uncertainty of not knowing whether the Federal Reserve is going to continue on that path or not. Okay? Everyone understands that in order to control inflation, we needed to increase interest rates. Okay? The way that we dissipate that inflation is by lowering the amount of money that's available, shrinking that amount, and the only gun that they have to shoot with is interest rates. So they increase interest rates so that people can borrow less and use less money, right? But then we don't know when are they going to stop increasing. And if you as an investor don't know when they're going to stop increasing, then what happens? Some people might freak out and start selling, which is what happened over the last 3 months. They thought, okay, we're going to continue to increase. Therefore, you know what? I'm going to stay away from the market. And that's the behavior. So the market has a lot to do with the behavior of consumers and the behavior of investors rather than these political things. Now, they do cause an impact, and obviously everyone is aware of if the Federal Reserve is going to continue to increase interest rates, then now I need to look out of whether I go into the market or not. But it doesn't dictate the pace of the market directly. There's some other events that could dictate the pace of the market, right? Like the Twin Towers. When the Twin Towers happened, that had nothing to do with political, or inflation or anything like that. It was just a terrorist attack. And obviously, we were under the pressure of going to war. So that's a different scenario where the market tanks. When the full tech crash, when the bubble burst on the technology sector, on the dot-com sector in 2000, that had other circumstances. So every time that there's a correction in the market or there's a bull market, a bear market, it's triggered by different things. And we as humans try to predict as much as we can, but we don't, hit the target all the time. Nobody could see a pandemic coming. That was something that pulled the market down, and then the market went back up, right? And it went back up because of consumption and because of the amount of money that was available and because of businesses buying back their shares, which automatically increases the price of their shares, right? So there are different things that will cause that behavior. Now, if we think that interest rates are high now or have, increased a lot, let me take you through history so that we can see where interest rates have been. And like I mentioned before, in 1980, they increased interest rates drastically, and they reached all the way almost that 20%, right? So this is not the first time that we've seen. And what happens with us as human beings is that we have short-term memory. I always say we have short-term memory. We remember whatever we want to remember, and we remember the last year only or the last 2 years only, right? And what's happened is that since 2008, when the real estate crash happened, interest rates stayed where? On the floor. 0.25 from 2008 all the way to 2015. Then they were starting to increase, and then they lowered them down, and then we hit a pandemic, and then they stayed down. So it's been about 14 years, 15 years almost, of low interest rates. If you have had this long strike of low interest rates and you're buying stuff at a cheaper interest rate price, then now when interest rates start increasing, you think that is outrageous. And it truly is not. Back in the 90s, interest rates were around the same place where they are right now for almost the entire decade. Okay? But it's always good to illustrate that and look at it in a picture. Now, if we go through that in numbers, and the reason why I got this snapshots of interest rate changes is to tell you a couple of things, right? When interest rates go up, that is not beneficial for borrowing money. However, it is beneficial for investors because banks are paying a higher rate, money markets, savings accounts, all of these things are paying higher rates. So if you want to put your money to work, it's a good atmosphere to do that safely, right? Do they stay up there forever? No, they change. How often do they change? Well, let's take a look. 1999 to 2000, interest rates were at 5% in 99, ended up at 6.5 in 2000. So they went up on that 2-year time frame. Then we had 2001, 2002, and 2003, and interest rates went from 6% in 2001 down to 1.75 by the end of 2001. So in 1 year, they dropped from 6 to 175. So the Federal Reserve has the ability to do that. Does that mean that next year we could see 5.5 going down to 1? Maybe, I don't know. And that's the uncertainty of not knowing what's going to happen with the decision of the Federal Reserve. That's why it's so important. So that happened, and then they dropped to 1% in 2002, 2003. After that, we experienced a boom on the housing market, right? From 2004 all the way to 2006, interest rates went up from 1.25 to 5.25 over that time frame. Okay? Now, after that, we start experiencing that crashing situation with the stock market, and interest rates dropped from the 4.75 to 2, and eventually they went to 0.25. And you know the rest of the story because I just told you. It stayed at 0 until 2015, started going up until 2018, and then it went down 2019, 2020, back to that 0.25%. And we stay there. So whoever refinanced their house in 2020, 2021, you did good. You're probably not going to see that again. You got that 3% or 4%, stick with it. That's a hell of a deal. Okay? And we're going to talk about that in a second. Now, this is what's happened so far. We went from 0.25 in 2022 all the way to 5.5 in July of 2023. And so far, the Federal Reserve stopped. Now, it looks like they came to a stop, and hopefully they did, and in December we don't have to deal with that anymore. And if that happens, then you already know by the information that I provided to you that there's going to be some holding period, freezing period, and then there's going to be interest coming down period again, right? So if you got money into a savings account, a CD, or something that's paying you a fixed rate right now, enjoy it. Is it going to last? Somehow it's going to last. Is it going to be forever? No. But in the meantime, enjoy it, because 2 years ago, if you went to the bank and you asked them for a CD, they would have told you, we'll pay you 0.000 nothing, right? And now they're calling you, hey, you got $30,000, $50,000 in the bank. We got CDs at 5%, right? Have you received any calls like that, or anybody has told you you should put that money to work? It's because of this, right? So, important to understand those things. Now, how do they relate to mortgage rates? Because this is the other thing that some people ask me that they quite don't understand. Mortgage rates are not the same Federal Reserve rates. So the Federal Reserve is a guide for financial entities to lend money at a certain rate or charge money at a certain rate, right? Not necessarily they have to follow those guidelines. It's not a law. It's not like the Federal Reserve says, you guys got to charge this interest rate. And usually financial institutions are not in the business of lending money to be, Mother Teresa or any charity. They're in the business of lending money to make money, right? So they will charge you and make a spread over whatever they're lending. So if we look at mortgage rates, and going through my things, I found this mortgage rate history table from April this year, because I looked at I did a real estate, it was a real estate seminar with somebody here, and we went about mortgages and how mortgages were being impacted by the increase on interest rates. And so at that time, in April of this year, the 30-year mortgage was at a rate of 6.28%. Okay? Now, if you notice, if you look at the graph, what I mentioned to you back in the 80s, absolutely true. Mortgage rates were on the 18%, 16%, right? But if you look at the graph, around the 90s, all the way to the 2007s, this was pretty steady. It was coming down, but it was pretty steady. And it was all above the 5% rate. It wasn't until 2018 that mortgage rates actually dropped. And they were about 3% or so. And they stayed around that, somewhere below the 5% mark. And so we consider that buying a mortgage at a 5% or less is a good deal. But if you actually look at the entire history and you go and average this out, the average of a mortgage hasn't been 5%. It has been between a 6 to an 8%. So if you're getting a mortgage at a 6% or 6.5 or 6.28 like you were getting in April, it wasn't a bad deal either. Could it be better? Absolutely. If you would have purchased at 2021, then it would have been better. But you missed that train. So this is what you get now. Now, the latest that I pulled was this one. Mortgage rates are almost at an 8% for a 30-year mortgage. And some people won't buy properties because of that, due to the fact that they cannot borrow the money that they need to purchase the asset. Okay? So interest rates are important because when you go qualify for a loan, depending on the interest rate that mortgage has, is going to determine the mortgage payment that you will have, or how much house can you buy with the income that you have. That's why those interest rates are important. So a lot of people that wanted to purchase homes between 2020 and 2022 and had the ability to purchase homes because interest rates were low, currently won't be purchasing homes because they cannot afford that mortgage anymore. So what does that do? That stabilizes the market. Back in 2021, we had 25, 30 people going for a house, bidding on the price of a house. Now we got 5 or 3. It's not that they're not purchasing, especially in Miami. We're still buying in Miami. And then in Miami, we do also get the internationals that have money and come with money and buy cash. So that's another factor, right? But that's one of the factors why things are slowing down in that market, in the real estate market, okay? Now, when interest rates go up, that affects the bonds market, which is something that actually pertains investors. How many of you have understand what a bond is? How many of you understand how a bond works? Any idea? So when you purchase a bond, you're lending money. You're lending money to an institution. It could be a federal government. It could be a municipality, like the state of Florida. It could be Miami-Dade County. Okay, you're lending money to an institution, or it could be a corporation. You're buying a bond of General Electric. You're lending money to General Electric. Okay, when you lend money to someone, what are they going to pay back? They're going to pay back your money plus interest, right? Now, when you buy a bond from the government, you're lending that money for 10 years, 20 years, or 30 years. And they guarantee that they're going to pay you an interest rate. And they're going to pay you the money back at the end of that period, right? Now, think about this. If you purchase a bond in 2020 and you went and got $10,000 worth of federal government bonds, okay? And the government was saying, we're going to pay you for this $10,000, we're going to pay you right now a 1.75% because interest rates are low and the bank is not paying you anything, but we're going to pay you at least 1.75 for you to lend us your money. It was a good deal back then, right? So you will get it. But guess what? Over the last 3 years, we just saw that interest rates kept going up. Now, the government doesn't issue bonds and stops issuing bonds in 1 year. They continuously issue new bonds. So bonds in 2023, the government is paying on this now 2.5%. Right? Let's say that you purchase one in 2020 that's paying you 1.75 for the next 20 years. So you get guaranteed that they're going to return your $10,000 at the end of the 20-year period, and they're going to pay you that semi-annual interest, right? 1.75 divided by 2, that's going to be every 6 months you're going to get that interest paid. Okay? You could get it yourself and spend it, or you could reinvest it and just let it compound. It's up to you. Okay? Now, there comes 2023 and you realize, oh my God, bonds are paying 2.5 now. And then you go and meet Miguel, and Miguel says, you know what, I feel like buying these governmental bonds. I think they're safe. They're backed up by the government, the federal government. They pay me 2.5. It's a good deal for 20 years, guaranteed, and they're going to give me my money back, right? And then you come and say, hey, you know what, I have one of those. I bought it in 2020, but it pays me 1.75. Why don't you buy it from me? Don't buy it from the government. Buy it from me. What would I say? Would I buy it? Would you buy it? No, right? You wouldn't buy it. Why wouldn't you? Because you make more money with a new one. Now, if you want to sell it, if you want to get rid of this bond, the only way that you get rid of this bond is if you lose value. If you offer it to me for $8,000 instead of $10,000, because it's paying less interest, right? Otherwise, I'm going to go buy the one that's current rate 2.5 or whatever that is. That's how interest rates affect bond prices. So we do have a lot of people, or we do have a lot of prospects that have come talk to us, and they have wondered, why is my portfolio, if it is invested in bonds, and bonds are supposed to be safe because they're backed up by the government, how is it that my portfolio is losing money? I had a client that I spoke to today, and we transferred her portfolio, and her portfolio was full of bonds. Long-term bonds, intermediate-term bonds, short-term bonds. It was all bonds, nothing but bonds. Now, when the market is suffering, when the equities market is suffering, bonds suffer less. That is true. But the problem is that when the market turns up and starts recovering the losses, the bond market doesn't recover as quickly as the stock market does. So she's seen the stock market recover, but she hasn't seen her bond portfolio recover. She's still suffering. And interest rates have kept going up and up this year, so she's been seeing those prices down and down more. Okay? Now, over the last year and a half, 2 years, we've been advising our clients not to put money in bonds, specifically for this concept. And for those of you that had money in bonds, we've removed the bonds, and you were actually better off putting your money into a money market or a CD. You would have made more money and not lose money. Okay? So bonds and interest rates have an inverse relationship that you got to understand if you want to keep bonds in your portfolio. I'm not saying that bonds are bad. I'm just letting you know that you got to understand how bonds work, right? if you want to go with bonds. In our case, we have a replacement for bonds, which is fixed index products. They continue to track the market, but they have no downside. So that's what we use to replace that portion of bonds. However, we still do have some clients that want to participate in the bond market, and they might want to take advantage of the recovery when the recovery comes, because there's going to be a recovery coming at some point, right? Interest rates are going to come down. And what happens when interest rates come down? Then this will go up, or this will go up if the price on that bond is higher, right? So important for that, if you have bonds in your portfolio, make sure that you review that with your advisor, okay? Make sure that you're looking at what you have. Sometimes it's better to let go of that bond that's not making you money and get on the stock market, because the stock market is an upside and you're going to recover that loss quicker, okay? Or look into what other options you might have, okay? So seek advice from an expert. Now, what alternatives are there for bonds, right? Like I mentioned before, we got money markets paying almost 5%, 4.98 on the Fidelity. Most of you know we use Fidelity as a custodian. If you have money parked in the bank doing nothing, that's a good fix. Put it into the money market. It's available 24/7. You can take that money out at any time, and it's at least making you 4.98 a year. Okay, so that's a good way of going at it. The other way is going into the market. How has the market performed so far? Well, until the beginning of November or the end of October, right? Not counting this rally that we just saw recently, market was up 12% for the year. That's not bad. Is it better than the 4.98? Yes, definitely, absolutely, right? Is it steady growth, Miguel, forever? No, you could see some swings up, down, and lately it was down, like I mentioned, the last 3 months. Right, now it turned back up. It's about right here, probably. Okay, I don't have the graph up today because we're cutting it by month, but it should be around here today. Now, in that field, we do manage a portfolio tactically, which means that we look for the sectors that are working and put more money into those sectors that are working so that we can maximize growth on that portfolio. That portfolio is this green line that you guys see here. That has gone up about 28% compared to the Standards & Poor's. Okay? Some people ask me, there was a client that asked me, how do you guys achieve that? That is impossible. No, it's not impossible. The technology sector has grown 40% this year. The communication sector has grown about 40% this year. The consumer sector, consumer discretionary or consumer cyclical sector, has also grown about 35%, 37% this year. Those three sectors are the ones pulling the market up. We have industrials, we have materials that are also up, but not as big as those three sectors. If you focus on investing on those three sectors, then you probably will achieve a better performance than the stock market by itself. But you gotta move tactically. You gotta know where to go. Was it the same last year? Absolutely not. What was last year a good sector to be in 2022?
Pharmaceuticals?
Not really.
No.
Healthcare wasn't. There was only one sector that moved up when everything was moving down in 2022. It was the energy sector. Did you guys hear about a war between Russia and Ukraine? And did you hear about the price of gas going up? And it stayed up for most of the year, still up. So last year, energy was the big player. Everything was negative. Last year wasn't about making a lot of money. It was about losing less money because everyone was losing. And that was the only wild card that you could play. Now, as an advisor, I will never tell you get all your money and put it into just that one sector. Don't ever do that. If someone tells you that, run out of there, okay? Because you got to diversify your investments. You got to put your eggs in different baskets, So we did put money into that energy sector, but we didn't put a ton of money into that energy sector. Okay, we put about 20 to 25% of the portfolio. That was about it. But by doing that, we were able to safeguard losing not 19% like the market, but only about 10, 9.7 or something like that. It was what we lost last year on the portfolio. So yes, we do lose money sometimes. We don't have all the answers and we don't have the crystal ball. I always like to tell people. And when the market is negative, everyone hurts. Now, if you're hurting less than other people, then it's an advantage for you, right? So that's another alternative that we can look into. Like I mentioned, fixed index accounts, right? Accounts that track an index in the market and could actually grow with the market, but not lose money. So we use a lot of fixed index accounts for retirement plans or people that don't want to participate fully in the market. Okay? So I ran two scenarios of $250,000 in two different accounts. Some accounts do have fees, as you see here, 0.95. Some accounts don't have fees, and you just get the growth of the market. Okay? But if we were looking at the last 10 years of the stock market working here, 250,000 will become about 449,000 on that version of that product. Now, that version of that product has an additional bonus just to sign up for about 19%. Okay, so we can use that to boost up the account because there's going to be a fee that's going to be charged. So when the market goes up, they limit your earnings. They only allow you to make up to a certain amount. So market going up 20% doesn't mean that you're going to make 20%. It means that you make only up to 6.5 or whatever the limit is, right? Some companies have a 6.5, some companies have a 9%, some companies have a 7.75. Why is it different? Because of the company or because of the product. Some products have a fee, some products don't have a fee, right? That's something that you should talk to your advisor about. And with retirement funds, this is the replacement for the bond market. You have no risk. You can make up to a decent amount of the growth of the market. Okay? If you have any questions about that, consult your advisor. Set up a meeting with your advisor. Hey, I want to check on my investments, see where my money is. I was talking to one of the advisors now, and he was telling me that he's meeting with a client, and the client is hesitant about the market. He doesn't feel good about the market. He feels that he's grown enough this year, and he wants to take some chips off the table. How many of you have gone to Vegas or have gone to a casino? Yeah? When you're winning, do you get out? You should. Most people don't. And that's why you end up losing it again and more, right? But if you're winning, take some chips off the table. Cash in. There's nothing wrong with that. Now, I want to continue winning. Okay, continue winning in a safer bet. Do something different so that you can safeguard some of your money from any losses or any future losses, right? Now, if you trust the market and if you trust the game, and you're good at it, then you keep the course. Or if you have time, you keep the course. But if you're close to retirement, you don't necessarily need to go and take that risk. It's unnecessary risk for no reason. And some people have grown enough. So it's important to also know when to pull the trigger and say, hey, let's take some chips off the table. Okay? I started my year with $200,000 invested in the market. Now the market is going up 12% or 20%. I got $240,000. I should remove some money off the market. Let me get those $40,000 that are gains and move it out. There's nothing wrong with that. Could those $40,000 continue to make me more money? Yes, they would. If the market keeps going up. Or they will lose me more money if the market goes down. So might as well just park it somewhere where it could be safe and still get some benefit from the market. Okay? Any questions? No questions. Awesome. It means either I'm doing a good job or you didn't understand anything that I said before. Either way, we're all done. We're coming up to a stop. If you're a client of ours and you want to meet with us, you might want to meet with our team of advisors. We have 6 advisors here, okay? We have Mauro, which is our founder. Some of you know him. He's been in the business for 40 years plus. Started in MetLife. Then he went on to founding his own business and brought his 2 kids into the business. One of them is another advisor, which is Sebastian. You might know the guy. He's very lovely. At least people say that. I don't know. Can't vouch for that. I love Seb. Then there is another Miguel. I call him Miguel 2.0, the better version of myself. I train him, I groom him, I nurture him. He's done well. He's really good. We got Eric, which we stole from Wells Fargo. Very talented guy. He's been in the business for like 18 years as well. So, good. We also have Jimmy. Some of you have had the pleasure to meet with Jimmy. And then there's me, right? The old Miguel, or the older version. The senior is what they say here in the office. So meet with any of us to look at your accounts, to see where your portfolio is, see if you need to use any of these alternatives, okay, or change anything in your portfolio. We're coming almost to the close of the end of the year. You should be having a meeting to see where we are heading next year, right? It's almost there. Turkey Day is what, next week? Yeah. And after Turkey Day, you guys know what happens. It's gone. There you go. If you're not a client, if you came for the first time, I hope I didn't bore you with my information. I hope it was at least entertaining and you got some knowledge. Okay? And if you want to meet with any of our advisors, set up a meeting. You have some yellow cards on your folders. You know, for those of you that are online, click on the link and set up an appointment, and somebody will reach out and we can do a meeting through Zoom. But get to do something, you know, get to do something if you need advice. Take action with an advisor to review your plan and your portfolio. Control your expenses now because everything is super expensive. We have a high inflation, everything it's up in price. Don't make unnecessary purchases. Okay? If you don't need to, don't buy it. Don't do it now. Interest rates will come down. If you can't wait for a year, I'm sorry, can't help you there. But if you can, if it's not necessary and you don't need it right now, wait it out. You'll get a better situation. Okay? Tell other people about us. How many people you might know that need some help?
So, Miguel, a question for you. You know, based on historical, our interest rates are not very high.
Based on historical, interest rates they're not very high, yes.
So, there's potential for it to come down beginning of next year. And I'm assuming the only reason that you would do that is because we take, and that's the only card the government has to try to get us out of that. So if you're saying that, then you're foreseeing a downturn in the market, because that would force them to lower the interest rates to try to shore up the market.
Not necessarily. What happens is that they suffocate the economy by increasing interest rates. There's less money flowing, and at some point they have to start letting more money into the system. It has nothing to do with the market. The decision of the Federal Reserve doesn't have to do with the market per se, but it has to do more with the economy overall.
When I say market, I mean economy.
Yes. Yeah, because usually when people talk about the market, they're talking about the stock market, but it's the economy. So at some point, they're going to have to start allowing more money to come into the system. But they are waiting for those prices to balance. to get lower, to get back to stability and not just keep increasing like crazy. Housing must be affordable. Right now, it's unaffordable for a lot of people, though. For the regular Joe, they can't buy houses right now. They have to rent, and rent is expensive still.
That's insane.
So somehow they're going to have to manage that. Now, when that happens, when those prices start coming down, I know that you have no faith, and you don't have faith on that happening. It might not happen in Miami, right? But remember, once again, we're not looking at just Miami. We're looking at a nation, 50 states, right? And that dictates everything. Now, I'm going to tell you something that I told to a client the other day, and I didn't want to say that, but hey, if you want to live in Miami, it might be expensive, and it might be more expensive than what you really can afford. So maybe you're going to have to move, Someone told me that. So I won't ever be able to buy a house in Miami. Well, if you want to go live in Manhattan, there's your answer. Can you live in Manhattan with your salary? Maybe no. And if you can't, you can't. There's nothing we can do. The government can help you, lowering interest rates and making it easy so that you can get into Manhattan. They have to manage the economy. So what I believe on that is the market is currently thriving. The market is on an upside. It will continue. Numbers are solid for the economy. Okay? Consumption hasn't stopped completely, but is not at the point where the Federal Reserve is concerned, which is good. And that brings us stability, right? Now, that also regulates the consumption because people are not spending as they were spending 2 years ago. That I can tell you. People are being a little bit more cautious at the supermarket. People are being more cautious about the vacations they take. They're being more cautious about, items they buy and selecting their budgets and deciding what to purchase and what not. And that's happening across the country. Maybe you don't see it in Miami, but that's happening across the country. Okay? And so that regulates prices. The cost of cars. Have you seen cars coming down in price from 2 years ago?
You're saying used cars are coming down in price.
Yeah. Why is that?
There's more products.
There's more product in the market. That regulates the pricing. Now used cars are going to come back to what used cars are valued. And when that happens, more people can afford used cars. Maybe not new cars, but used cars. Does that make sense? And that keeps the economy flowing. It's a whole cycle. Now, what we think right now for the stock market, the market is going to end the year in a positive note. That we definitely do know. Okay? Now, coming next year, some people do have concerns about election year because it's an election year, and election years are crazy. Historically, election years haven't been negative. Okay, they haven't been extraordinary. They haven't been amazing for the stock market, but they somewhat have grown, 6, 9, 10%. And they do swing, depending on what's happening. Okay, now is it better for the market if you got Republicans in the White House or Democrats in the White House? The difference is very small for the stock market. It's about a 1% difference or 1.5% maximum on the performance of the stock market, because the stock market doesn't depend on whether the president being Democrat or Republican. It depends on what's happening with the price of stocks and companies growing and how the capitalism is developing in the country, right? And this is going to sound very American, but I do believe a lot in the capitalism of America. We've been one of the financial powers in the world because we hold the biggest businesses in the world. If you think about it, how many huge companies, worldwide companies, are located in North America, in the U.S. specifically? How many are abroad? If you look at the bigger names, bigger players, they're all in here. And that's been happening over the last 100 years. Because we do have great business owners. We do have great business people, and we do have great minds as well. And if we don't have great minds, we hire great minds from somewhere else. That's what we do. And we're really good at that. So I do believe on that economical system that we have here, right? Now we can talk politics, and politics is a little bit, on the sidetracks. Everyone has their own opinion and things, but for the market, election year hasn't been damaging. There's only, I think that I went back probably like 30, 40 years, and there's only like 2 or 3 times that the market was actually negative on an election year. The rest of them, positive, absolutely positive. So that's not a concern. Now, if the Federal Reserve comes to a stop, then now it's just the market behavior. There's no uncertainty about what's going to happen. Then we'll get back to looking at earnings calls every quarter, seeing how sales are performing, seeing how the economy is developing, prices are stabilizing, consumption being where it needs to be, And not every time the technology sector is going to dictate the pace, or the communication sector is going to dictate the pace. Sometimes it's going to be healthcare. Sometimes it's going to be industrials. That could happen. So we just got to know where to allocate our funds. Does that answer your question?
Yeah.
Any other question? No? We're good for tonight?
Great.
Do I get to go to my wife? Thank you very much for coming. And like I said, make an appointment with an advisor if you need to. All right?
Fantastic.
Thank you.
Appreciate it.
You have a good night.